Here is a statistic about Warren Buffett that almost nobody actually knows, and it changes how you should think about everything else in this video. Over 99% of Warren Buffett's net worth was built after he turned 50 years old. The overwhelming majority of it was built after he turned 65. Buffett bought his first stock at age 11. He was already, by any reasonable measure, an extraordinarily skilled investor by his 30s and 40s, running a fund that dramatically outperformed the market for 2 decades. And yet, the vast majority of the wealth associated with his name did not exist yet at an age when most people are already deep into their careers, raising families, and well past the point where most financial content tells them their best investing years are behind them. This is not a story about genius alone. It is a story about a specific, repeatable, learnable set of principles, applied with extraordinary consistency over an extraordinarily long period of time. Principles that a Canadian investor in their 20s, 30s, or 40s today can apply directly inside a TFSA using nothing more exotic than a handful of low-cost ETFs. This video covers 5 of Buffett's most foundational, well-documented investing principles, what each one actually means in practice, and specifically how to apply each one as a Canadian investor in 2026 and beyond, because, unlike a stock pick or a market prediction, these principles do not expire. One of them explains why Buffett avoided an entire industry for over a decade, while people around him got rich investing in exactly that industry. We get to that one in segment 3. If you want to keep your money mindset sharp and learn how to make your capital work for you, consider subscribing to the channel and liking this video. It truly helps the channel grow and teach people about financial education. Now, let's get right into today's breakdown. Buffett has long emphasized in various forms across decades of public commentary that the extraordinary outcome of his investing career is overwhelmingly a function of time, not unusual annual returns. His own widely cited explanation for this, his annual investment returns, while excellent, were not dramatically higher than many other successful investors throughout history. The difference is that he sustained those returns for an unusually long period, beginning in childhood and continuing for more than 8 decades. The mathematics behind this. Compound growth is exponential, not linear, meaning the absolute dollar value added in any given year grows dramatically larger as the underlying base grows larger, even at an identical percentage return. A 10% annual return on a $10,000 base adds $1,000. The same 10% return on a $10 million base adds $1 million. Identical percentage, vastly different dollar impact, purely as a function of the base having had decades to compound. This is precisely why the majority of any long-term compounding investor's net worth, Buffett included, accumulates overwhelmingly in the later years of the compounding period, even when the percentage return itself remains roughly consistent throughout. The Canadian application? This principle has a direct, immediately actionable implication for any Canadian investor. The specific number of years your money has to compound matters more than almost any other variable you can control, including, in many realistic cases, the specific return rate achieved within a reasonable range. For example, the difference between an 8% and 10% return matters considerably less over a 10-year horizon than the difference between starting at 25 versus starting at 35 matters over a full career. A Canadian who begins contributing to a TFSA at 25, invested consistently in a diversified equity ETF, and a Canadian who begins at 35 with the identical contribution amount and identical return, the 10-year head start alone, by the mathematics of compounding, typically accounts for a meaningfully larger share of the final difference in outcomes than almost any reasonable variation in investment selection between the two. The actionable takeaway: the single highest leverage decision available to most Canadian investors is not finding a marginally better performing fund or stock. It is starting today rather than waiting, and remaining consistently invested for as many years as possible, because time, more than skill within a reasonable range, is the dominant variable in the entire equation. Your action step: calculate how many years you have between today and a realistic retirement age. That number, more than any other single piece of information, should inform how aggressively you prioritize starting your investing habit immediately, rather than waiting for a better or more informed moment to begin. Buffett has summarized his approach to risk, in widely cited public remarks over many decades, in roughly two ideas. The first priority is avoiding permanent loss of capital, and the second priority, distinctly secondary to the first, is growing that capital. He has framed this not as caution for its own sake, but as a recognition that losses and gains are mathematically asymmetric. The asymmetry, explained: a 50% loss on an investment requires a 100% gain just to return to the original starting value. A 33% loss requires a 50% gain to recover. A 20% loss requires a 25% gain. As the size of a loss increases, the percentage gain required to fully recover increases at an accelerating, non-linear rate, meaning large losses are disproportionately more damaging to a long-term compounding outcome than equivalent-sized gains are beneficial. This asymmetry is the core mathematical reason Buffett has consistently emphasized capital preservation as the foundational priority ahead of growth, because a single severe, permanent loss can undo years or even decades of otherwise successful compounding. Why permanent is the key word. Buffett's framework specifically distinguishes between temporary paper losses, a stock or fund declining in value during a market downturn, while the underlying business or asset remains fundamentally sound, and permanent loss of capital, an investment becoming genuinely worthless or being sold at a loss during a panic, locking in a decline that might otherwise have reversed. A temporary decline in a fundamentally sound, diversified investment is not, in this framework, equivalent to a permanent loss, provided the investor does not convert the temporary decline into a permanent one by selling during the downturn. The Canadian application: for a Canadian investor using a diversified low-cost equity ETF such as XEQT, which spreads risk across approximately 9,000 companies globally, the single greatest practical threat to capital preservation is not market volatility itself, which is a normal, expected, and historically temporary feature of equity investing, but rather the investor's own behavior, selling during a downturn and converting a temporary decline into a permanent, realized loss. This reframes protecting capital for most ordinary Canadian investors not as avoiding the stock market or favoring overly conservative holdings, but specifically as maintaining the discipline to remain invested through downturns in a properly diversified portfolio rather than panic selling at the worst possible moment. Your action step: before your next significant market downturn occurs, and one inevitably will at some point, regardless of when you are watching this, write down in advance a specific commitment to remain invested through it, based on the asymmetric mathematics covered in this segment. So the decision is made calmly now rather than emotionally during the event itself. Here is the vault from the opening. The principle that explains why Buffett famously avoided an entire industry for over a decade, while people around him became extraordinarily wealthy, investing in exactly that industry. Buffett has long described, in interviews and public letters spanning decades, the concept of a personal circle of competence. the specific, honestly assessed boundary of what an investor genuinely understands deeply enough to evaluate with confidence versus what they merely think they understand or are simply following because others are excited about it. The famous example, technology stocks in the late 1990s. During the dot-com boom of the late 1990s, as technology stock valuations soared and many investors who had never previously owned technology shares rushed in, often with little understanding of the underlying businesses, Buffett, by his own well-documented public explanation, largely avoided the sector. His stated reasoning was not that he believed technology was a bad investment category in some abstract sense, but specifically that he did not feel he could confidently evaluate years in advance which specific technology companies would still be thriving, profitable, and competitively dominant a decade or more into the future. A type of confident long-term evaluation he felt he could make more reliably in industries he understood deeply: consumer goods, insurance, certain financial and industrial businesses. He was, by many public accounts at the time, criticized for this, seen by some commentators as having lost touch with where the market's energy was. The dot-com crash of 2000 to 2002, which wiped out a substantial portion of the value of many speculative technology companies that lacked proven, durable business models, is widely cited as a vindication of this specific application of the circle of competence principle. Not because technology was inherently a bad category, but because the specific evaluation required, forecasting which young, unproven companies would still be dominant a decade later, fell outside what Buffett judged he could reliably assess. Why this principle is widely misunderstood. The circle of competence is not, as it is sometimes casually summarized, an argument for intellectual laziness or for refusing to learn new things. It is specifically an argument for intellectual honesty about the difference between genuine understanding and superficial familiarity, and for declining to make confident, large financial decisions in areas where that honest self-assessment reveals a gap. The Canadian application. For the substantial majority of Canadian retail investors, including highly intelligent, financially literate people in unrelated professions, the honest application of this principle leads to a specific, practical conclusion. Very few people have the genuine depth of industry-specific and company-specific knowledge required to reliably evaluate individual companies' long-term competitive prospects, with the kind of confidence this framework requires for concentrated, large bets. This is precisely the insight underlying the case for low-cost, broadly diversified index investing, covered extensively elsewhere on this channel, as the practical, honest application of the circle of competence principle for most people, rather than attempting to evaluate individual companies outside one's genuine area of expertise. Owning a diversified ETF like XEQT or VFV sidesteps the need for that specific evaluation entirely, while still capturing the long-run growth of the broader economy. Your action step: honestly list any individual stocks you currently hold or are considering. For each one, ask specifically, do I have genuine, deep knowledge of this company's competitive position and industry, or am I primarily following general excitement, a recommendation, or a recent price trend? The honest answer should directly inform whether that specific holding belongs inside or outside your own circle of competence. This is one of Buffett's most widely cited and most widely misapplied ideas, paraphrased here from decades of his public letters and interviews. A disciplined investor should generally feel more cautious when market sentiment is broadly euphoric, and asset prices reflect that euphoria, and more willing to act decisively when market sentiment is broadly fearful, and asset prices reflect that fear, because prices driven primarily by emotion, in either direction, tend to deviate from a business or asset's actual underlying value, creating opportunity for a disciplined, unemotional buyer or seller. The famous historical example, the 2008 financial crisis. During the depths of the 2008 financial crisis, when fear in financial markets was, by virtually any historical measure, extraordinarily elevated, and many investors were selling assets indiscriminately, Buffett made several large, well-documented investments, including a widely reported investment in Goldman Sachs' preferred shares on favorable terms during the crisis. This was not, by his own explanation, an attempt to time the absolute bottom of the market, which he has repeatedly said is not something he attempts, but rather a deliberate decision to act when others' fear had created favorable terms for a long-term oriented buyer, based on his assessment of the underlying business's fundamental soundness rather than the panicked sentiment of the moment. Why this is widely misapplied. The mistake many retail investors make in attempting to apply this principle is treating buy when others are fearful as a license to buy anything that has recently dropped sharply in price, regardless of whether the underlying asset is fundamentally sound. Buffett's actual application of this principle has consistently depended on a prior, careful assessment, tying back directly to Principle 3, the circle of competence, of whether the specific asset in question is a fundamentally sound business experiencing a temporary, sentiment-driven price decline, versus a genuinely troubled asset whose falling price reflects a real, lasting deterioration in its underlying value. The Canadian ordinary investor application. For the substantial majority of Canadian investors who hold diversified ETFs rather than individual stocks, this principle translates into a specific, much simpler and more mechanical version than Buffett's own company-by-company analysis. Maintaining, and ideally increasing, regular investment contributions specifically during broad market downturns, rather than pausing or reducing contributions out of fear, precisely because a diversified ETF holding thousands of companies is, by its very structure, far more likely to be a fundamentally sound asset, experiencing a temporary, sentiment-driven decline than a single company might be. This is the practical mechanism behind a strategy frequently discussed elsewhere on this channel. Dollar cost averaging through downturns, which automatically and mechanically applies a simplified version of this principle without requiring the kind of individual company judgment Buffett's own version demands. Your action step. Decide in advance and in writing what your specific behavior will be during the next significant market downturn for your automated contributions, explicitly committing now to maintain or increase them rather than leaving that decision to be made emotionally in the moment, when fear is at its highest and the temptation to pause will be strongest. The final principle is less about a specific financial decision and more about a sustained habit that underlies Buffett's ability to apply all four preceding principles consistently over decades. An exceptionally consistent, long-term commitment to reading and continuous learning, widely documented by Buffett himself and by those who have worked closely with him, including his longtime business partner, the late Charlie Munger, who has been quoted across many interviews describing Buffett and himself as people who read extensively, continuously, for the entirety of their careers. Why this matters for the framework as a whole. Each of the four preceding principles, patience over decades, capital preservation, staying within a circle of competence, and disciplined contrarian behavior during emotional market extremes, requires ongoing, accurate information and continuously refined judgment to apply well over a long career. A circle of competence that is never expanded through continuous learning eventually becomes a limitation rather than a strength, as industries and the broader economy evolve over decades. Capital preservation judgments and contrarian timing decisions both depend on an accurate, continuously updated understanding of which underlying businesses or assets are genuinely sound versus genuinely troubled. An understanding that requires ongoing study, not a one-time assessment made early in a career and never revisited. The compounding analogy. Just as Buffett has repeatedly emphasized that financial capital compounds more powerfully the longer it has to grow, knowledge and judgment, applied consistently over a long career, compound in a similar way. Each additional year of study and pattern recognition builds on the accumulated base of everything learned previously, making each subsequent year of learning more valuable and more efficiently applied than it would have been without that foundation. The Canadian practical application. This principle does not require a Canadian investor to read at the volume Buffett has famously described in his own life. It requires, more modestly and practically, a sustained commitment to ongoing financial education. Understanding how markets, accounts, and tax structures actually work, well beyond a single video or article, paired with the humility to continuously update one's understanding as new, credible information emerges, rather than forming a fixed view early on and never revisiting it. Why this is the principle that ties the other four together. A Canadian investor who understands Principle 1, the dominant importance of time, is more likely to start early and stay invested. One who understands Principle 2, the asymmetry of losses, is less likely to panic sell. One who understands Principle 3, the honest circle of competence, is more likely to choose diversified, low-cost ETFs over speculative individual picks outside their genuine expertise. One who understands Principle 4, disciplined behavior during emotional extremes, is more likely to maintain contributions through downturns. All four of these outcomes depend on the kind of sustained, ongoing financial education this fifth principle describes, which is precisely why continuous learning functions as the foundation underlying the entire framework, rather than as a separate sixth idea. Your action step. Commit to one specific ongoing source of financial education, whether a book, a channel, or a regular practice of reading primary sources like annual reports or reputable financial journalism, and treat that commitment with the same long-term consistency this entire video has applied to investing itself. Let's come back to where we started. Over 99% of Warren Buffett's net worth was built after he turned 50, the vast majority of it after 65. Now, you understand exactly why that statistic is not a footnote. It is the entire point of this video. Buffett's 5 core, well-documented principles: the dominant importance of time, the priority of protecting capital before growing it, staying within an honestly assessed circle of competence, disciplined contrarian behavior during emotional market extremes, and continuous learning sustained over decades, are not 5 separate tricks. They are 5 mutually reinforcing habits that, applied consistently for an extraordinarily long period of time, produced an extraordinary outcome. None of these principles require genius. None of them require insider information, a finance degree, or unusual access. A Canadian investor in their 20s, 30s, or 40s today can apply every single one of them, starting this week, inside a TFSA using nothing more sophisticated than a low-cost, diversified equity ETF, a commitment to remain invested through downturns, an honest assessment of what they do and do not understand, and a sustained habit of ongoing financial learning. The wealth did not arrive quickly, even for Buffett. It arrived because the principles were applied with extraordinary consistency, for an extraordinarily long time. That is not a discouraging fact. It is the most encouraging fact in this entire video, because it means the framework does not require you to be exceptional. It requires you to be consistent for long enough.